On Wednesday, May 4th, Chairman of the Federal Reserve, Jerome Powell, announced the first 50 basis point rise in short-term interest rates in years. And the status of quantitative tightening, that's the Fed balance sheet runoff schedule. Federal Reserve moves are newsworthy to your investments, whether they're behind inflation curve or not. I'm Chris Paris, Chief Investment Officer at Oak Harvest Financial Group in Houston, Texas. And this is our investment team's midweek release when we examine a news item, headline, or story making the rounds from publicly available sources, and we ask, is it news or is it noise? This week's topic is last week's Federal Reserve move to raise the Fed funds borrowing rate by 50 basis points and the announcement of the Fed's plans for balance sheet runoff for the second half of this year. Before we continue, please take a moment to click on the subscribe button and click on the notification bell so you'll be notified when our team uploads our latest content. In the meeting last week, the Fed also directly stated they expected to raise by 2 more 50 basis point moves at the June and July FOMC meetings. These numbers appear to be already reflected in shorter-term Treasury market yield curves. Powell shot down the talk of a 75 basis point hike at upcoming meetings for now. As for the Fed's balance sheet, they announced a combined $47.5 billion per month runoff for the next 3 months, and then doubling that to $95 billion per month starting around the fourth quarter. This is a little less up front and a little faster down the road. They specifically stated that their intention is to be visible and direct in their guidance to lower volatility and its impact on the market. The explosion in volatility across asset classes the last 2 weeks has coincided with the market's mood swinging wildly with the Fed talk surrounding 75 basis point hikes and Powell breaking out the Paul Volcker references. We continue to expect a summer slowdown due to higher mortgage rates and fewer government handouts to consumers. However, the consumer remains in a good place with low unemployment and higher trending wages. We've stressed since last November that this should be a sloppy, choppy mess of the first 3 quarters of 2022. And yes, it's turning out messier than we had imagined or forecasted almost 6 months ago as a combination of higher long-term interest rates on the back of elevated inflation, while economic growth is now slowing, has cut the S&P 500's forward earnings multiple by about 5 points in just a few months. While tough to stomach, longer-term investors should like lower valuations the markets are now providing. We think the Fed is on the right track, albeit it's slow and late. Their messaging needs to stay visible and rational, which would lead to lower volatility and higher valuations in the second half of this year. The Fed's interest rate path is definitely news to your investments, and we'll keep making it reporting news to our viewers throughout the year ahead. Give us a call here to speak to an advisor and let us help you craft a financial plan that meets your retirement goals. Give us a call here in Houston at 877-896-0040. We're here to help you on your financial journey into and through your retirement years. I'm Chris Paris, and from the whole team here at Oak Harvest, have a great week.